It's really hard to put your money into the stock market when the market is all-time high, and the stock market is really overvalued today. But how do we know that it is overvalued? You might think that a higher price means higher valuation, but this is not necessarily true. So how do we value a stock? Let's say that the price of a stock is $100 and the company earns $10 every year. Now we can attach a number to it. We just divide the price of the stock with the earnings, so this number would be 10. This is one of the most common ways of evaluating a stock, and we call this the PE ratio. The P stands for price, the price of the stock, and the E stands for earnings. So if the company makes $10 a year and the price of the stock is $100, the PE ratio is 10. But if the company makes $5 a year and the price of the stocks is $100, the PE ratio is 20. Or another example, if one of the companies has a stock price of $100 and it makes $10 a year, and the other company has a stock price of $200 but he makes $20 a year, they both have a PE ratio of 10. So even though the second company has a higher price, the valuation of the company is the same. Now the stock market average also has a PE ratio. When we talk about the market average, we talk about the S&P 500. The S&P 500 contains the 500 largest companies in the United States. So if we look at the PE ratio of the S&P 500, we can see the valuation of the market average. You can see that the average was always around 15 for the past 200 years, but right now it's close to 35. This is how we know that the market average is overvalued now. So how do we invest now that the market is overvalued? The first method is called dollar cost averaging. If you want to invest passively, which means that you don't want to pick individual stocks, you can buy an S&P 500 passive index fund, also called an ETF. So this way your money will be in the market, but you don't have to worry about how individual companies are doing, because the market is always growing over time. Now you might think that what if you put your money in stocks today and the market crashes tomorrow? Which has a really high chance since we know that the market is all-time high and it's overvalued. You might think that you will wait for the crash and you will buy stocks cheaper at the bottom. This is proven to be the worst strategy. I have friends who want to invest in stocks, but they are waiting for 3 years now because they waited for a crash. They would have earned a lot of money if they would start to invest 3 years ago. First of all, you don't know when the market is at the bottom. Sure, if we look back now to last year, we can see that there was the bottom. But when we were there, nobody knew that we are at the bottom. Take a look at the chart today. Are we at the top now and tomorrow will be a huge crash? Or the market will go higher tomorrow? Nobody knows that. I know that the market will be much higher 15 years from now, 20 years from now, but we don't know how many crashes will be until then. So it's totally impossible to time the market and invest at the bottom. But the good news is you don't have to time the market. And there is proof for this. They calculated 3 scenarios. In the first scenario, a person invested only at the top and the market crashed the next day, just at the worst time. In the second scenario, the person invested only at the bottom, after the market crashed. We know that both of these scenarios are completely impossible. And in the third scenario, the person invested his money every month, no matter where the market was. It turns out you can make the most money with the third strategy. This is called dollar cost averaging. So if I would just start to invest in passive index funds today, I would just buy it every month for the next years. If I would have a huge pile of money to invest, I would probably not put all of it into the market, but instead I would divide it for the next 12 or 24 months. So this way I would buy at the bottoms and at the tops too. And this has the benefit of being in the market all the time and earn money instead of waiting and losing money. And I would never buy stocks only at the bottom or at the top. Instead, I would have an average price. The second method to invest today is picking individual stocks. As I said before, the market average, the S&P 500, contains about 500 companies, but not all of these companies are overvalued. For example, Tesla has a PE ratio above 1000. Yes, 1000. Netflix has a PE ratio of 85. These kinds of companies are included in the S&P 500, and that's why the average valuation is high. But there are companies that are not overvalued today. For example, I bought Philip Morris this month with a PE ratio of 14, I bought Omnicom with a PE ratio of 13, and I also bought Merck with a PE ratio of 11. I talked about these stocks in a previous video. Of course, in order to pick stocks, we need to know how to evaluate individual companies. Picking stocks is not just about buying stocks with a low PE ratio. I have an 8-step process of how I filter the stocks I buy every month, and the PE ratio is only one of these filters.